Okay, welcome back to Chapter 8. Chapter 8 is about self-employed retirement plans and qualified business income deduction. The important part is business income deduction that is kind of common because you're gonna have Schedule C in your tax returns, and Schedule C will end up by having a business income deduction at 1040. So let me see if I can find a full 1040 for you. So here is the page 1040, the first page. And if you look at the bottom, you see line 13, qualified business income deduction. That is 20% of the income as a form of deduction from your income. That is a help to sole proprietors. They use Schedule C. There is a threshold on income. It's about, I believe, gosh, I'm not memorizing it, but about $350,000, something like that. If the income is below that threshold, then you will be able to use QBI. The reason they offered this QBI because back in 2018, the tax changes for corporations. They reduced the corporate tax, and then sole proprietors they were kind of left outside that benefit. So they came up with this idea of giving a QBI, qualified business income, 20% tax deduction, income deduction, and that will help also the sole proprietors. So they didn't want just to help corporations and leave the Schedule C outside. So that's how they came up with this idea. Okay, let's see what's inside this chapter anyway. This is not a big chapter, so should be okay. So in regards to what we are going to look at, we are looking at the various types of retirement plans for self-employment, and also learn how to calculate QBI deductions. This is continuation of the chapter 7, which is self-employment, but just focused more on retirement and QBI. One thing that you probably it's a good idea to know what it is having a retirement benefit called defined benefit plan. Defined benefit plan focuses on annual benefits at retirement. Employers must contribute annually to the plan so that promised benefit will be available at retirement. So the key word is this, I believe, promised benefit. So it says defined benefit plan. That means your benefit is already defined. And they have to give you that type of benefit that you're supposed to get, no matter what, which means it's a really good plan. So if you work somewhere that they have promised benefit to you, that's a place to work. But in contrast, there is another one that nowadays, normally businesses, they like to give you this one, defined contribution plan. That means it focuses on annual contributions. The amount contributed is usually a percentage of employees' compensation. Unlike a defined benefit plan, this type of plan promises no predetermined benefit. No predetermined benefit. That means whatever you get, that's whatever you get. It might be really good, it might be really bad, whatever it is. When you go for retirement, at that moment, you will see what you're gonna get. Instead, annual contributions are made to individual employee accounts. So employee then receive whatever benefit accumulates in their respective account, whatever. You see, that's the word, whatever you receive. There is another plan that is, they call it SEP, which means Simplified Employee Pension Plan. That's a little bit kind of retirement account, but they made it a little bit less complicated. So people who are, companies that they are using this, they don't have too much trouble to offer this. So the plan is defined contribution plan again. This is the same word, defined contribution plan. Employers can establish for their employees. In 2022, the maximum contribution an employer can make to an employee's SEP is lesser of either $61,000 or 25% of employee's compensation. Let's say an employee has $100,000 compensation. 25% of 100,000 is 25%, 25,000. So that's what they go. They go with the lesser of 61,000 or 25%. An alternative to SEP, it's more common, it's a 401k plan. The main advantage to 401k plan is over SEP is that employees can make pre-tax contribution. So in 401k, you have an option to pay pre-tax contribution. That means momentarily you pay less taxes because your income will be lower and you pay less taxes. But whatever you put in 401k, it will become all of a sudden taxable income, including whatever you earn on that investment when you are retired and you take distribution. Therefore, reducing the taxable wages. So taxable wages goes down. That means employees will pay less taxes at that moment. They can contribute up to how much? $20,500 to a 401k. So we have a regular, let's say 401k or Roth IRA that you create for a personal, purpose, and that's maximum contribution. I believe it's $6,500. But here, because this is through your employment 401k, then you can contribute up to $20,500 in this 401k that is offered by your employer. Employers age 50 and older, they can put a little bit more, $27,000. That's also good, right? Okay. A common practice, it says employers may offer to match up to 50%. If there is a matching offer, normally it's a good idea employees put as much as possible till they get, higher matching by employer. So but not everyone is doing that, so it's not mandatory. There is also a Roth IRA. So employees contribute to Roth IRA after tax. So in that case, anything that has been accumulated in the retirement account, when you take a distribution at older age, it will be tax-free. But in Roth 401k offered by your company, employer, it's okay, it's good, right? Because it's after tax, then everything will be tax-free at the later time, but they cannot, here, only the employee can contribute to Roth 401k. That means employer cannot contribute. In regular 401k, employer can contribute, but in Roth 401k, employer cannot contribute. So here we have an example. Bobby is 42 years old. He participates in 401k plan at work, okay? His employer offers both a standard 401k and Roth 401k. In 2022, Bobby designates that $13,000 of his pre-tax wages be designated to his 401k. This allows him to designate up to another $6,500 as an after-tax contribution to his Roth 401k. Why? Because the limit is $20,500. So you can go up to $20,500. If he puts $13,000 pre-tax, he has opportunity to put actually 13 minus 25 in year 2022. That's 7,500, not 6,500. So 7,500 additional in Roth 401k. And his taxable wages will decrease by $13,000 because he put money in regular 401k. Here, the reason they made a mistake, because every year that limit is changing. I believe in 2021, that was 19,500. In 2022, it became 20,500. For 2023, I'm not sure what it is. It should be something either 20,500 or maybe a little bit more. You can Google it. Same facts in example 1, except Bobby is 51. So Bobby is older than 50, right? 50 and older. So he can put $13,000 in regular 401k, and he can put 13 minus 27, what is that? 14,000. He can put up to 14,000 in Roth 401k with after-tax money. So there is something they call it simple. Simple is saving, incentive, match, plan for employees. So employers that have 100 or fewer employees who earn 5,000 or more in the prior year can adopt this simple plan. Employers can set up simple plans using either IRAs or 401ks. Employees who earned at least 5,000 in any 2 prior years are expected to earn at least 5,000 in the current year would be allowed to contribute up to $14,000 for simple of their salaries to plan for 2022. Employees 50 and older can contribute $17,000. Employers generally are required to match up to 30% of employees' compensation. So you're not gonna memorize all this, but just is good to kind of read and go over it. You will forget it anyway, but the fact is just as long as you are familiar with it, that should be enough. There is another plan, they call it QO plan, which again has the same limitation. The maximum contribution for QO plan is 61,000, lesser of 61,000, or 25% of participants' compensation. That is same as the SEP that we already discussed. But here is the tricky part in computing the maximum allowable contribution. Self-employed taxpayers first complete Schedule C to find out the net profit. After net profit is cleared, then they compute self-employment tax, so they can deduct that from the profit. And also half of so they can deduct half of this self-employment tax from net profit. And self-employed taxpayer may contribute up to 20% of the remaining amount to defined contribution plan. And defined contribution plan, one more time, it's a plan that you contribute to it, but in future, there is no guarantee what you're gonna get. You get whatever you get. It's not defined benefit plan, it's defined contribution plan. Okay, let's see if we find an example. Here is an example. So Lloyd, a self-employed taxpayer, has a Schedule C net profit of $60,000. His KIO plan requires a 25% contribution each year. Net earning from self-employment is 60,000 times 92.35%. You know why is 92.35%? That is 100% of your income less half of self-employment tax. Self-employment tax is 7.65% for Social Security and Medicare. The other 7.65% is responsibility of employees themselves to pay. So as a so-called employer of himself, the half of Social Security and Medicare has to be paid by employers. So technically income is not 60, income is 60 minus half of Social Security and Medicare, which is remaining 92.35%. So 92.35% of 60,000 is 55,410. That is net earning from self-employed. Got it, right? A little bit tricky, hard to explain, but that's what it is. Self-employment tax is 15.3% of 55,000, which is 8,478. What is 15.3% coming from? That is Social Security, 12.4%, plus Medicare, 2.9%, combined 15.3%. But 15.3% of what? 15.3% of the net profit after reduction of half of self-employment tax. So self-employment tax is 8,478. Lloyd reports $4,239 as an adjustment to income on Schedule 1, which goes to Form 1040. So here is the Form 1040, and here is Schedule 1 somewhere, right there. So it will become an adjustment to income. So half of self-employment tax goes in line 10. Of course, goes to Schedule 1, and then from Schedule 1 comes to line 10. And here is the Schedule 1. Line 15, deductible part of self-employment tax. And also if you have Schedule C, remember I said never put health insurance expense in Schedule C. Health insurance expense for the owner of the business never goes in Schedule C. The owner of business, health insurance for himself and his family goes in line 17. Okay, so Lloyd reports 4,239, half of the Social Security and Medicare on Form 1040 from Schedule 1. Using the required percentage of 25% of his compensation, Lloyd set up a formula to solve for the required contribution. So 25% of Schedule C net profit minus half of self-employment tax, and minus contribution. So that is the, in this example, it's 25% times 60,000 minus half of the Social Security tax and Medicare tax, which is here, FICA, half of FICA, minus contribution to Q plan for retirement, equals to C, which is the Q plan contribution. So if you solve for C, doing math, so it's 55,000 minus C times 25%. Again, just solve for C, that will become $11,152,000 contribution permitted to put in Q plan. Okay, what is Q plan? It's kind of, again, it's a retirement plan, made it a little bit easier. The plan must be established before the end of the tax year. The plan must be in writing, and employees must be provided a summary description, including rules. The plan should be intended as a permanent plan and must have a designated trustee, like a financial institution or a bank or something. And the contribution must be made by the due date of the tax year. So, and here is the information that says taxpayers can make contribution to qualified retirement plan until the due date of the tax return, and that will still be counted towards the last year benefit. And remember, we covered SEP, and we said 61,000, lesser of 61,000 or 25% contribution. That's the maximum can be contributed towards the SEP. And SEP is a defined contribution plan of retirement. So the IRS says, provides an alternative calculation on the limit. The maximum compensation that may be taken into account is $305,000. Therefore, the maximum contribution is $61,000, which is 20% of $305,000. So if you have more income than that, bottom line, you cannot contribute more than $61,000. As with the CUBE, self-employment taxpayers may contribute to SEP until the due date of the return, which is April 15, including extensions. However, unlike a QO, SEP does not need to be set up before the end of the tax year. Self-employed taxpayers have until the due date of their tax return, including extension, to set up a SEP plan. SEP plan have another advantage. They have no annual reporting requirement. QO have annual reporting requirement, even if the taxpayer is only participant. So SEP doesn't have its due date to be before the end of the year, and also less reporting requirements compared to QO plan. So Vince is self-employed as a SEP during 2022. He reports Schedule C net profit of $49,520. His self-employment tax is 92.35% of $49,520 times FICA ratio, which is 15.3, 12.4 for Social Security plus 2.9 for Medicare. So self-employment tax is 6,997. In his deduction for half of the self-employment tax is 3,499. That goes in Form 1040. Means maximum SEP contribution is 9,204, which is, again, based on that math, 20% times 49,450, that number, minus self-employment tax, and whatever it is times 20%, that's 9,204. And the software, if you have a software, the software will calculate. But this type of retirement plan needs a trustee. So you have to have a financial institution to help you in the plan. And they will also do the reporting to IRS. Okay, so let's continue on this. So simple requirements are there must be 100 or fewer employees in the previous year. So it's not for big companies. They specifically made it for small companies. Is only retirement plan offered, so they shouldn't have no other type of retirement plan. All employees, they have to have at least $5,000 of compensation. The maximum sole proprietors can contribute to their own simple plan in 2022 is lesser of 14,000 or 100% of their compensation, whichever is less. Sole proprietors 50 and older, they can contribute another 30,000, ends up to be 17,000. So SEP, simple plan, it's just kind of for small businesses if they want to offer. And that simple plan, you can create this even if you are the only worker, right? So you can have maybe just yourself, few more people. It's easier to make that simple plan. Okay, so I think that I want to spend time on it. First, interesting pass-through entities. You know what pass-through entity is, right? Anyone? Pass-through entities is like S corporation, a partnership. That means they file the taxes for the business, but they pass it through a K-1 form to each shareholder. And then shareholders take that K-1 form plus W-2s, whatever they have, and they prepare tax returns. So you get a client that comes in with a W-2 and a K-1 form. You enter the W-2 first, and then you go find the form that says K-1 and click on that. And that form is exactly just like the form that you have. All those numbers in each single box in K-1 form has to go inside. Let's see if I can find a picture of it. You see here is K-1 form 1065. That's partnership K-1. This one says K-1 form 1120S. That's S corporation K-1. So let's click one of them. So this is what you get when your client comes in with the K-1. It says the company name, federal ID number, percentage of shares that you have, like here, percentage. What percentage you have as an ownership, 50%, 30%, whatever it might be. If it's only you, then you get 100%. And then ordinary business income and all those boxes you see, there might be a number in it. Some of them will be blank, but few of them will be some number. So all those numbers, you have to make sure that goes in the software exactly in the right place. Okay? And sometimes we have something in other information here, which you might have a number with a code. And again, in the software, each code means something. So try to comply as much as possible, put it correctly, don't mess it up. Because IRS has the same copy, so you want to kind of match it with the IRS information. Okay, so for QBI or Schedule C, you will have some 20% income reduction possibility. So the income must be from the U.S. trade or business. Certain income is not QBI, even if it's effectively connected to the U.S. trade. Each taxpayer must compute QBI separately for each trade or business. So if you have 2-3 businesses, then you have to calculate. Software will do it for you, so don't worry about it. Provisions that vary for this is deduction is generally limited to only 20% of total income. Income from a specific services business may or may not be part of the base for the QBI deduction, depending on the amount taxable income. Let's say accountants, they are not part of QBI for some reason. Looks like whoever made this QBI rule, his son-in-law was not an accountant. However, I'm guessing his son-in-law was an engineer, because for some reason, engineer is in this QBI qualifications. So my only conclusion was whoever made this, probably his son-in-law is an engineer, so he wants to make sure that his son-in-law gets 20% QBI. So the amount of deduction may depend on the qualified business W-2 wages and blah, blah, blah. So there's few rules for QBI, so it's not that easy. There are some restrictions on it. Certain income is not QBI as we could guess, even if it's effectively in a US connected business. Long-term and short-term capital gains and losses, that's not included. Dividends and equivalents, that's not included. Interest, other than properly allocable qualified trade or business. And so interest is not included. Annuities type of income is not included in the QBI calculation. So they take this type of income out of this calculation so you don't get too much big QBI. So they try to have that QBI calculation specifically for your regular type of business operation, not because you have income from long-term or short-term capital gains, or you have income from dividends or interest or annuities, not those. The thing that you really work for it. In addition, wage or salary income received from activity does not constitute QBI for an S corporation shareholders employee. So wage or salary income received from the activity does not constitute QBI for an S corporation. So if you get wage or salary from somewhere, and that is gonna be added to S corporation, that wage and salary is not part of S corporation. It's not, it's not gonna be used to calculate QBI.
Can you, after dividends, is it equivalents other than patronage, dividends from cooperative?
What is that, patronage dividend?
Yeah.
I believe there are some businesses that they call them cooperatives. I don't know exactly what type of business it is. It says if you get dividends from that type of cooperative business, but Google it what cooperative business it is. It means, it says if you get dividends from that, that might be included, but overall, dividends are not. So I don't know what that patronage dividend from cooperative might be. I've never seen it myself. I never had experience with it. I don't know.
And this goes on Schedule K1.
Schedule K1.
You just showed that just now. Schedule K1.
You see in Schedule K1, you see here we have several boxes. That's why we have several boxes. So they can kind of identify that where this income that you have some percentage of share from it coming from. Make sense? Yeah, you might say, oh, from my S corporation, I got $100,000 share of income. But where is that exactly $100,000 coming from? Is it from dividend? Is it from annuities?
You have an interest in it, but and then it could be self-employed. So are you get something like 1099? It comes in the mail. You get something in the mail for this.
Okay, 1099s are included because you worked for it. You got 1099, right? So they are trying to identify this because they have several boxes here. They are trying to identify that what portion might be long-term gain, what portion might be dividend, what portion might be interest, what portion might be annuities. In order to calculate QBI, they're gonna take all those numbers out. It's not gonna be used for QBI. So if you have $100,000 share of K1, after deducting long-term capital gain, dividend, interest, and annuities, you end up with $30,000.
Yeah.
And then they use $30,000 multiplied 20%. 20% of $30,000 is gonna be only $6,000 in QBI.
Yeah. And I'm just wondering, is that percentage of interest, is it reported that by the partner or the other people with interest, do they report the percentage?
No. All you need to do when you get a K1 form, in this K1 form, it says on the left side, it says what's the company name and data and information and percentage of shares.
Mm-hmm.
Everything else from that S corporation that got some form of income, interest or whatever, it will be distributed between these boxes in here. That's why these boxes are so many lines in here available, because we have so many type of incomes with different codes. That's why I said some of them has codes, E, B, C, something like that. So you have to also in your software choose the right code, because every code means something. For example, if you look at, let me make it bigger here. For example, if you have short-term capital gain or loss, that will be in line 7. Yes, you have $100,000 of income, but no, you're not gonna say, oh, 100,000 times 20%, that's $20,000 of QBI in Form 1040. No, if you have line 7 something, that $100,000 is gonna go down, gonna be less. If you have, let's say, qualified dividend or ordinary dividend interest income, those are gonna take your $100,000 income share of K1 lower. So your QBI will not be 100,000 times 20%. It will be some 100,000 minus some stuff, then multiply 20%. So that some stuff, here is few examples of it, that will be deducted from your K1 form, and then they multiply it by 20%. So if the taxpayer's taxable income is less than QBI, the deduction limit is 20% of taxable income. So qualified business income is what normally you use to multiply by 20%, right? However, if it says taxpayer's taxable income happens to be less than QBI, then the deduction is 20% of taxable income, not 20% of QBI. And why taxable income will be lower? Because you have so many other things that you might deduct it from your taxable income to arrive at taxable income, right? And that's why your QBI might be a little bit higher in some cases than your taxable income. In that case, you multiply 20% with the less amount of the taxable income that you have. For this purpose, taxable income does not include anything taxed at capital gain rates. These include long-term capital gains discussed in Chapter 11 and qualified dividend. You know, remember qualifying dividend, they get better treatment in regards to taxation. Taxable income is calculated without regard to the QBI deduction itself. So Virgil has $150,000 of AGI, adjusted gross income, in 2020. All $150,000 qualifies for the QBI deduction. He's single and does not itemize deduction. Based only on his QBI, his deduction would be $30,000, which is 20% of 150. His taxable income before the QBI deduction is AGI 150, standard deduction is 12,950, taxable income before QBI is 137. So now this 137 is less than $150,000 QBI. Therefore, Virgil's taxable income will be used to multiply by 20% because it's lower, and that will be, instead of 30,000, it will be how much QBI? $27,000. $27,000. And that $27,000 for 10 will be in line 13. Right there. Okay? 27,000, not 30. Another example, the software will calculate it for you, but we are just trying to look at an example to get some idea. Dale and Doris are married and file a joint return. In 2022, Dale has $120,000 of income from a qualifying business. Doris has $100,000 of qualified dividends. They have $12,000 of self-employed health insurance deduction and $45,000 of itemized deduction. Their taxable income before the QBI deduction is qualified business income is 120. Qualifying dividend is 100,000. So that's 220. Self-employment health insurance deduction from Schedule 1 is 12,000. That's this line. Line 10. Self-employment health insurance deduction is 12,000. And if you want to see Schedule 1, self-employment health insurance deduction is line 17, which ends up in the Form 1040, line 10. You see, I'm trying to track the lines for you, okay? And your job is to understand this tracking.
Definitely.
Your job is not to calculate QBI in a real life because the software will do it for you. My concern is you can track the numbers from one schedule to Form 1040. If you can track that, then you can do quality review on your return to understand, okay, these numbers, yes, is coming from this schedule, yes, into 1040, yes, it makes sense. If it doesn't make sense, that means you made a mistake somewhere. That means you checked the box somewhere or you didn't check the box somewhere. So something is wrong. So the idea is to understand how to track. Yes.
It's just the only thing is the test, like, you kind of have to figure out those numbers and,
To do quality review of your tax return or someone else's tax return, you have to understand how to track it. Okay, so far so good, right? QBI is under $20,000 qualified business income, but qualified dividend is 100,000. That's another form of income. Self-employment health insurance will be deducted. So your adjusted gross income, AGI, it's $208,000 on Form 1040. Dale and Doris are below the 2022 threshold for married taxpayer filing jointly. So they are not limited by wages paid by Dale business or qualified property of business. See below. There's a limitation on income for QBI. I didn't see it yet. It's 350,000 something, but how come I didn't see it? It's not showing anywhere. Looks like it still is not showing, but QBI has an income limitation. Okay, so let's continue. It says there, the 2022 threshold of filing jointly, the income is below that. So they are not limited to by wages paid by Dell business or qualifying property of the business. If no other limit applied, the QBI would be 108,000, which is 120 minus self-employment health insurance will be 108 if there is nothing else. This would be yield a deduction of 21,600, which is 20% of that amount. AGI is 208, less itemized deduction is 45,000, less qualifying dividend, which is not qualified for QBI calculation, is 100,000. That gives you 208 minus 145, that gives you 63,000. 63,000 is less than 108, right? Make sense? 108 is coming from 120 minus self-employment health insurance. Yes, normally you like to multiply that with 20%, but wait. Taxable income is only 63,000, which is AGI less itemized deduction, less, remember qualified dividend are not included, less that. So it ends up to be 63 times 20%, gives you 12,600. So $12,600, that's the number goes in for 1040 line 13. Make sense? Here is the threshold that I was looking for. Okay, so the taxable income has a threshold, as I said. Here are the numbers for year 2022. Numbers are changing a little bit, so you don't need to literally memorize it. But it's, you remember I said it's something like 340, 50,000, something in that range. So here we go. It says threshold is $340,100. God knows where they came up with $100, right? That's for merit filing jointly. Phase out for wages and property limit and service income is 100,000. So that 100,000 is the phase out section. That means start going down. The QBI will, income deduction will go down all the way till you get to $440,100 income. Then you will totally lose any QBI income deduction whatsoever. So for single, the same threshold is 170,000. So far, so good? Remember I said there are few businesses that are qualified and few businesses that might not be qualified. Let's see. The qualified business income legislation was not intended to cover professional services. However, for persons of moderate income levels, amount derived from service professions may qualify for the deduction. Any taxpayer whose taxable income exceeds the threshold plus phase out is not able to claim a deduction whatsoever. However, any taxpayer whose income is below the threshold shown above may claim the deduction, in part or in whole. The following activities are a specific service, trade, or business, like health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, investing and investment management, trading or dealing in securities, partnership interest, or commodities, any trade or business where the principal asset is the reputation or skills of one or more of its employees. So these people, they don't get any PDI. Okay? I don't know why. And accountant are one of them. So if you are engineer, look at here, engineer is also professional service, right? You provide your engineering service to someone to draw a plan or whatever. That's not in here. And that was the claim that I said. I said, well, whoever did this, his son-in-law is engineer. So specifically, they took that engineer's name out of this list. Honestly. And just so you know, there were few people, and I don't remember who was that senator. He said, if you don't take that engineer out, I'm not gonna sign. So he literally put gun on head of those legislations, said, if you don't take that engineer out, I'm not gonna sign this. And they were so hard in getting enough signatures to pass this law. They were literally begging for that signature. So they end up by taking engineer out. And then he said, okay, now I will sign. So that's why I'm saying, wait a moment, what's going on with engineers? How come engineers are professional services too? So I'm guessing someone is very close to him, an engineer, and he doesn't want to. So Steve is an attorney. He's married and files a joint return. In 2022, Steve's income from his law practice was $250,000. The other income was $70,000, and itemized deduction for the year were $40,000. Since their combined taxable income before the QBI deduction did not exceed $340,000, Steve's law practice income qualifies for QBI deduction of $50,000. So law practice, watch here. You see the law is here. How come he gets that thing? I don't know. Law should not be included. It's in the list. Laura is a partner in an international CPA firm. In 2022, her income from the practice was $80,800, and her taxable income before any QBI deduction was $1,050,000. None of Laura's income from the accounting practice qualifies for QBI deduction. Right? Okay, I understand that. The income was too high. But as far as I know, the qualified business income legislation was not intended to cover professional services. Okay, let me explain this part so it gets clear. It is not, QBI is not for professional services like whatever you see here. Okay? However, it said, if your income is below that threshold, we consider you as a small type of business, even though it's professional, but small type of professional business, then you can use QBI, no problem. But if you have the same type of business and your income is above that $340,000 threshold, then you cannot use QBI. So QBI is not for professionals unless your income limit is below this specific threshold. Where was that threshold? Below that threshold. So if you keep your income below that threshold, as a small business, they let you use QBI. But the moment you grow larger, more than this threshold, no more. For professional services like accountant, law, athletics, all those stuff. You will not be part of it. Engineering is not in here. That means if you are engineer and you make $1 million of income, still you are qualified. Make sense? So in this example here says, Laura is a partner in international CPA firm, right? In 2022, her income from practice was $800,000. You see, if Laura was an engineer, he would or she would be qualified. But because she's an accountant, then his income or her income is too high. Is not qualified. Here, Steve is qualified, even though he is a law practitioner, but because his income is not large income, he's kind of low income type of business. So they say, okay, you can use QBI. Also, QBI has a limitation, which is W-2 limitation. In general, a taxpayer's QBI deduction is limited to 50% of W-2 wages paid by qualified businesses. However, there are some exceptions in this rule. First, the limit does not apply to any taxpayer whose taxable income before Section 199 Cap A deduction, which is QBI. The QBI comes from a section called Section 199 Cap A. That's where QBI deduction and rules and regulations comes from. Got it? So whenever I say Section 199 Cap A, we are talking about QBI. Got it? So first, the limit does not apply to any taxpayers whose taxable income before the QBI is less than the threshold amount. So if you are below the threshold, that limitation will not apply. What is the threshold? The $340,000 that we were referring to. The threshold and phase out are the same as discussed above. Second, a taxpayer with substantial depreciable property may qualify for combined W-2 wage and property limitation. Okay, so what is the trick? Trick is this QBI deduction is limited to 50% of W-2 wages. To understand this, we have to look at this example so you can see. But keep this in mind that 50% of W-2. Okay, Martha is self-employed at architects. In 2022, she's single. Her earning from her brokerage is in 2022 after self-employment tax, self-employed health insurance deduction, and retirement plan contribution were $156,000. She paid $30,000 of wages to her employees and properly reported these on Form W-2. So how much wage did she pay? Only $30,000 of wage, okay? She had $22,000 of interest income and claimed $18,000 of itemized deduction. Her taxable income before the QBI deduction is income from job is $156,000, interest is $22,000, so AGI is $178 minus itemized deduction of $18,000 for $18,000, I believe, is, she's single. So if she's single, standard deduction is 12,000 something. So it's better to use itemized deduction. So here is the itemized deduction, 18,000. So taxable income before QBI deduction is 160,000. Keep that in mind. Since Martha's taxable income is less than single taxpayer's threshold of 2022, which is $170,000. Remember the threshold? That number. So 160 is less than that threshold. Her deduction does not depend on W-2 wages paid. Got it? So W-2 wages paid will be irrelevant because the income for QBI calculation, $160,000 is below that threshold. Otherwise, that 50% of wages would be a limitation in how much you can go. 50% of that, 50% of 30. But we're not gonna go over there because 160 is less than the threshold. So she claims a QBI deduction of 31,200 since her QBI is less than her taxable income. So we are good. Now, when taxable income exceeds the threshold plus the phase-out range, the QBI deduction is 50% of W-2 wages that the business paid. So here, Martha from example 12 had $122,000 of interest income and claimed $18,000 of itemized deduction. Her business did not have any substantial qualified property. Her taxable income before the QBI deduction is income from business plus interest. AGI is 278. 278 minus 18 for itemized deduction. That's 260. The 260 is more than $170,000 threshold for a single person. So all of a sudden, 50% of W-2 will become important limitation. So since Martha's taxable income exceeds the single space threshold plus phase out range for 2022, the deduction is limited to 50% of W-2 wages. She claims a QBI deduction of $15,000, which is 30,000 times 50%. So that's it. Since the amount is less than 20% of her QBI. So the QBI deduction will be only 15,000. Okay, that's enough for today. That is chapter what? Chapter
8.
Chapter 8, yes. I don't see anything in chapter 8 that much left. You can read the rest. There's a bigger example here that I suggest go over it later on. It's the same example, but a little bit more, comprehensive. So look at it and read it later on.